Taking a look at McDonald's today. This is one of the stocks that I trade quite a bit. Got it up on my screen here. This is my EMA wave indicator. I'll put a link below if you want to know how to set this up on one of your charts. But basically it just kind of gives me an idea what the trend is and where it is within the buy zones I look for. And this is a Keltner channel, 2 standard deviation Keltner channel here, the white lines. Obviously it shows that McDonald's had exceeded that, which is why I was looking at it. This was after an earnings event. Even though I was watching it, honestly, I missed the best buy opportunity here because it really was this candle where we had come on the RSI, we'd come below and started back up. You know, this was actually a good sign that I should have gone long here. This candle came out, and because it was so strong, I really felt that I would get more of a pullback on this day. So I didn't do anything. However, I think now that I'm going to try to look and see what kind of entries I can get. What would be the best way to set this up to trade? Let's take a look at another chart of McDonald's. These are my Bollinger Bands that I use. You can see we've got a big expansion here in the bands, and you'd expect them to snap back at some point. As you can see, they do continuously. So that tells me that, you know, as McDonald's hit this 3 deviation Bollinger Band to the downside, I was watching it all through here, and I said, well, when should I buy? When should I buy? You know, when should I go long? Because I really like McDonald's. It just kept pushing down, and again, this right here was really the time that I should have gone long this next day, and this candle scared me off a little bit because it already pulled back to the 1 standard deviation. But there's still a lot of room for it to come back to the mean. Now this is going to continue down, so even if it just trades sideways, it's going to come back to the mean. However, it does limit what the best trades are, because if it's going to trade sideways here, you don't want to do a debit spread. You don't want to buy the stock. You don't want to buy a call because you're just going to lose time value as it trades sideways. The second issue I have is, okay, if I want to go long, if I think that the stock's going to continue back up or sideways, you know, where is my stop? You know, for whatever trade I decide to place, where am I going to put my stop? Where do I determine that, okay, I messed this up? Really, the best place to put it is going to be, you know, right here. Yeah, this is probably going to be your best stop point, and there's a big difference between where it's at now at 196 and 191. So that's another concern I have as I look at this trade. It's a pretty substantial, you know, move down for my stop. The other area that I could place a stop would probably be right about here, which is at 194. With the current movement of the stock, I don't really like that. The stock market itself is still pretty strong. It had a sell-off yesterday, but it's still moving up. And with this sell-off in McDonald's, I really think that you could expect to see quite a bit of upward momentum still. So I'm not. Yeah, so I just really think that this stop is too close, though. So this is the stop I want to be at. The other issue I have, if I want to go long here with a debit spread, well, actually a debit spread would work because implied volatility is pretty low at McDonald's, even though we've had this opening. Of course, it stays fairly low usually on McDonald's, so you could take a chance and go ahead and enter a sell-up position if you wanted to, I guess, but I would have rather have done it right here if I was going to do that. With the way the implied volatility is right now, it does mean that you could buy a debit spread at a decent price. You could also buy a call at a decent price, and you could do a calendar here and get a decent price on that. The other trades I would like to do typically would be a credit spread at about the 190 level, or a broken wing iron condor. And the reason I say a broken wing iron condor as opposed to a regular iron condor is I do still expect a move back up into here. So there could still be a lot of volatility. I could protect myself down here, but I would on the top side, on the call side of the iron condor, I might have some issues. With a broken wing iron condor, I could set that up so that I can make money as long as it finishes over maybe 190. That's what I try to do. 190, 250 would be the second choice, and then it could go down as much as it wanted. I'm sorry, it could go up as much as it wanted. I can make money. I'd only lose money if it came down. But with implied volatility the way it is, I'm not sure that's the best trade. So let's take a look at some of the credits you can get right now. If I wanted, I don't mind owning McDonald's long term. So I wouldn't be opposed to selling just a naked put. And if I go 14 days out, I can get the 195s for about $1.55 or so. And that's going to give me that means I'll be in this trade if I got assigned the shares for about 193.45. That's $3 less than where it's trading at right now. That's 14 days away. I could also go out 28 days and I could sell the 190s for $1.16 to $1.23. So we'll say I sell for $1.20. Well, if I sell the 190s at $1.20, that would put me in this position at $1.88.8. So let's see where that is on the chart. So that would put me in here about right here. This would be my break-even point. And if you look back through the chart, that's actually not a bad place to be. You've got a lot of buying and resistance and support through here. You've got a lot of bounces off that line there. I'd like to get a little more credit, but that's not a terrible trade. And then you would also have the option, to roll that if you wanted to. I trade a lot of VXX puts and calls, and I'll continually roll them. So that's not terrible, to be in here at this level. The other thing you could do is, if you didn't think it was going to go up very much, you could sell this 190, and then you could even sell maybe a 205 naked call to make this into a strangle, and you could sell that for about, say 60 cents. So if you sold this for $1.20, that for 60, that would get you in this at about $1.80 credit. So if you got assigned to the downside, that would put you in at about $1.88 or so. Not terrible, but you do have upside risk. And anytime you sell a naked option, you also have a lot more risk as far as if the stock did go to zero, then if you sold one contract, then you're going to be out about $18,000. You could sell a credit spread here at 190, and that's not a bad trade either. It probably looks like you would get about 70 cents for it. So you'd have a $500 risk for 70% gain. But I typically don't hold credit spreads when I place them to the end. So I would be looking at probably trying to close that at about 50%, which is only $35. The other thing you could do, though, is you could come up to this 195 and you could sell a credit spread here at 195.90 for $1.49. So that's a $149 gain on a $500 risk potential gain. And if you're trying to close it for, say, 50%, then you're looking at about a $75 gain is what you're realistically targeting. Your break even here would be the 195 short minus the $1.49. So your short, that puts you at a break even about 193.50. So let's see what that looks like. So your break even would be right here, which is below one of my stop lines. And that brings the question in, if it starts to threaten it, do you just close that position? If you want to wait till your short strike is hit, which is at 195, and that's not very far away, then you're probably going to be looking at about a $250 buyback on that $500 spread. So you have about a $100 loss if you were able to close it right at the short strike. That'd be about a 50 delta at that time. So that's a possibility too. But let's look at one other trade here. Let's look at what a calendar would do. I trade a lot of calendars. I have about a 60% win rate on them, which is not terrible. My profit loss is about a 1-to-1. So overall, they're profitable trades for me. Let's look at about 8 here. Let's look at 7 days out, which is next week. And let's look at the Decembers. So right now, I could sell a 195 call for about 270, and I can buy a 195 35 days away for about 440. So that's pretty good because that's about half. Now this is in the money, and typically I would prefer to do my calendars out of the money, which would be put us at the 197. But I do think there may be a little more weakness here based on this calendar, but this candle, it's an indecision candle, but this was a big update. So that either means it's going to take off, or I think it's going to pull back a little. And I'm leaning toward it pulling back toward 195, which is right here. So if I think that's what it's going to do before it takes off, long term, I really think this is the low. We'll find out if I'm right. And I'm not always right, but I do try to place my trades so that if I'm wrong, I can adjust. And that's the key here. You need to be able to adjust these trades. You need to know when to get out. These aren't fire and forget. And I do lose trades, and I win on more than I lose, but I do lose from time to time. I really like the idea of this 195 calendar. You could do the 197.50. If I did the 195, I would hold this calendar probably until right here. If it closes below this 191, I would close this calendar out, take whatever loss or gain I had. So the trade I would make here would be the 195. So let's go ahead and buy a calendar. And we want to sell the November 8th, which is this one. We want to buy the December the 6th. So I'm going to get into this for $1.61 debit. So I will go ahead and place this for ever how many contracts you feel comfortable placing. And your target here would be to sell this for about a 25% gain. So that means you want to try to sell this for about a $2 credit. $2 to $2.02 credit. And that's your target. Once you place this trade, if I was placing this trade, I would go ahead and set a $2 credit to get out and just leave that as a good till close or good till cancel. If it hits, it hits. If it doesn't, it doesn't. Next week, I would reevaluate it, and you might roll this 195 to November and pick up another credit. Now, you're going to be losing some time decay here as it moves forward. The only two dangers you have is I would put an alert right here. So if it drops below here, I would close the position. Gain, loss, doesn't matter. I would close the position. Because if it closes here, then my idea that it's going to either consolidate, slightly pull back, consolidate, and move up is wrong. So I would close the position here. If it moves up into this $2 range, 200 range, the calendar could also finish with a loss. Because if it gets too far away from your strike, that would also cause it to be a loss because of the way the options are priced. So there is a danger if it does take back off into this area, this 200, 205. Typically, I do not put an alert on this type going up. I just take that risk and see what happens. Because I know I can roll it and wait for it to pull back if I need to and hope it pulls back. The only time I would close the position early would be if it hit my 25% gain. Now, if I do roll it next week, it's going to reduce the debit that I've got in this trade. So what I would do then is I would recalculate my close. So instead of $1.61 in it, or $161, I may only have $120 in it. So then my new target would be about $1.50. So it would reduce my overall return, but I'm still trying to get the same credit for whatever risk I've got out there. So that's what I would do here. I would do the 195 calendar. This would be the trade I would make here with low volatility. You know, if it stays between 200 and probably about 193, I make money for next Friday. If the volatility goes up, I make money. So, you know, those are things I'm looking at in the calendar. The calendars are trades I really like. You know, like I said, this is for educational purposes only. You need to make your own decisions concerning what you want to trade. I'm just trying to show you how trades work and give you some ideas. If you like this video, please subscribe. Please put comments. Please like the channel so I can continue to make these videos for you. If you have any questions, like I said, put them in the comments, and check out our website. And I hope to hear from you soon. Thanks.